Are you moving back to Canada? Here is a hidden tax surprise most people don't think about. If you're a Canadian and spent part of your career in the US and rented out your Canadian home while living there, Canada may treat your return as a taxable event, even if you didn't sell. When you move back in, it's called the Change of Use Deemed Disposition Tax. The CRA acts like you sold the home at its current value and taxes the gain. You still get a partial primary residence exemption for the period you used the home as your primary residence prior to making it a rental. Your gains will be taxed based on a ratio of how many years it was used as a primary residence versus the years you own the home. You also get one bonus year in the equation. In hot markets like Toronto and Vancouver, values can rise fast, potentially leading to hundreds of thousands of dollars in taxable gains. In Canada, half of your capital gain gets taxed at your marginal tax rate. If you're in the top tax bracket, you could lose 25% or more of your gain to taxes. Many returning Canadians owe $100,000 or more in taxes, even though they never sold, all because they moved back into their previous home. A big unexpected tax bill like that can really throw a wrench in your retirement plans. Unfortunately, some people who were affected by this rule did retire before moving home, and they are faced with the choice of either returning to work or adjusting their standard of living. The good news is that smart planning can reduce or avoid the tax. Talk to a cross-border expert early. Your return should be like a homecoming, not a tax nightmare. Let's look at an example. At the top here, we have the equation used to figure out the ratio of how much of your taxable gain is included in your income. So at the top, we have the number of years used as a primary residence plus one, there's that bonus year I was mentioning, over the numbers of years you own the home. In this example, the client owned the home for 30 years. They lived in it in 10 years, then moved to the US and rented it out for 20 years. They're then moving back into the home after 30 years, so their equation is going to be 10 plus 1 over 30 or 11 over 30, which means we're going to be looking at the inverse of this, so they're going to be having a 63.33% inclusion rate. If they had a $500,000 capital gain, half of that would be taxable, so $250,000 is taxable. If we apply the 63.33% inclusion rate to that $250,000 taxable gain, you get $158,325, which is your taxable gain. If you're in the top tax bracket, this means you could end up paying $79,000 or more in tax to move back into your home. So plan ahead and protect your future. Call us if you're crossing the 49th parallel. From the desert to the tundra, we are your cross-border retirement experts.